Good morning, everyone, and thank you for joining today. As the head of Treasury, I have seen securitization evolve from a niche instrument to a strategic tool for liquidity, funding, and capital efficiency. Our goal today is to break down both traditional securitization and self securitization and anchor them in our day to day Treasury strategy. You will leave this session with a clear understanding of how these structures work and how we might leverage them in our own context. At its core, securitization is about converting illiquid assets like mortgages into tradable securities. We do this by transferring the assets to a special purpose vehicle, that is SPV, which issues securities backed by those assets. Think of it as unlocking cash from the assets we are already holding without needing to sell them overnight. Let's understand this complex financial concept, securitization, through a much simpler and more familiar lens, a story about apples. This analogy will help you understand the logic behind securitization without any financial jargon. Imagine a farmer who owns hundreds of apple trees. He harvests apples every week, but he got a challenge. He doesn't want to wait for the customer to buy apples individually over time. He wants a lump sum of money right now to invest in his farm. Sounds familiar? It is like a bank holding a lot of home loans, valuable over time, but not immediately liquid. To solve this, the farmer gets creative. He bundles apples into baskets. Each basket contains apples that will generate future sales. Similarly, a bank bundles its loans into packages. Instead of selling each apple or a loan one by one, he offers whole baskets, just like a securitization packages many loans together. Not all apples are same, so the farmer grades the baskets. Basket A has only top quality apples, low risk of spoilage. Basket B is a mix, some great, some average. Basket C has mostly average or brushed apples, high risk but cheaper. This mirrors how loans are split into tranches in securitization from low risk to high risk category. Now the farmer sells the baskets to different buyers. Risk averse buyers pay more for the basket A. Others takes basket B or C for a discount, hoping for the better returns. In finance, investors chooses tranches based on their risk appetite. The farmers or a bank gets cash upfront and buyers take the future cash flow risk. Everyone is happy. The farmer gets the funding he needs now. Buyer gets the type of apple they are comfortable with. Risk and returns are shared appropriately. This is the core logic of securitization. It helps convert future income stream into a immediate funding while spreading the risk. Let's connect the dots. The farmer is the bank. Apples are the loans like home mortgages. Baskets are securitized product. Example RMBS. Buyers are the investors. Through securitization, banks get access to funding, manage risk, and serve more customers. And just like in the Apple story, everyone wins if the structure is well designed. In a typical residential mortgage backed securities, that is RMBS deal, multiple parties interact to package, structure, sell, and service a pool of mortgage assets. Each role is crucial to ensure the transaction meets the funding, regulatory, and operational objectives. I will walk you through each participant's functions and how these roles are typically structured in AUBL's own securitization transaction. Let's break this down. Originator. This is AUBL's in our own example. We originate the loans and we initiate the securitization process by selling them to a trust or SPV. SPV is a special purpose vehicle, a legally separate entity that holds the mortgage pool. Its bankruptcy remote to protect investors and isolate asset risk. Investors. These are typically institutional investors who purchase the tranches of securities issued by the SPV. They receive principal and interest payment from the underlying mortgages. Servicers, usually also AUBL, we continue collecting mortgage payments and manage customer relationship post securitizations. Trustees, an independent party like Perpetual, appointed to oversee the deal, protect investors' interest, and enforce the trust deed. Rating agencies. Rating agencies like Moody's or S&P evaluate credit risk of each tranche of the issued notes. This guides investors' pricing and appetite. Account bank hold the cash collections and distributes them according to the waterfall rules. Sometimes AUBL perform this role, but it's often an external or neutral person performs this activity. Let's make it tangible by looking at a scenario for AUBL as a textbook transaction case study. Originator and servicers. AUBL originates the mortgage loan and continues to service them post securitization. SPV. AUBL RMBS Trust 2024-1 was created to hold the pool of assets and issue the securities. Trustees. Perpetual was appointed as a trustee to act in the interest of note holders. Rating agency. S&P assigned a rating to each tranche of the notes. Senior tranches usually gets AAA. Investor in this case are super funds or asset managers of fund houses and other institutional investors subscribe to the deal, often via syndication. This type of setup allows AUBL to raise cost effective term funding, manage capital more efficiently, and build in operational capacity or capabilities for self securitization if needed for liquidity contingency. Here is a simplified diagram to visualize how all these participant interacts. AUBL sells a pool of mortgage loan to SPV. SPV funds this purchase by issuing securities to investors. The monthly repayments from the borrowers cash flow into ASPV via AUBL as a servicer. The cash is held by the account bank and distributed through the waterfall. Senior tranches first, then mezzanine, then equity holders. The trustees oversees the operations and ensure legal compliance and investor protection. Rating agencies continuously monitor the credit performance of the notes. This structure provides transparency and predictability for investors while offering AUBL a powerful funding and liquidity tool. Securitization is it not just one-off exercise, it's operationally intensive. We must ensure clean data, accurate loan types, legal robustness and ongoing compliance with APRA requirement. Treasury risk, legal and finance team work together to keep this structure updated. We also need to test systems readiness periodically to ensure that the quick activation during the stress events are performed. Now think of an RMBS like building a water irrigation system. You divert cash flow from thousands of mortgages into a pipeline split into a layers which is a tranches and channel it periodically to different investors. Today, we will break this down into step by step flow from asset transfer to investor payments. Think of this like separating clean produce from a farm and packaging it in a separate box for resale at a grocery chain. The SPV is that a separate box. The SPV isolate the asset from AUBL's balance sheet. This legal separation is what gives confidence to investor that even if AUBL faces stress, the mortgage cash flow are still secured. Now let's understand structuring of nodes like airplane boarding. First class, that is seniors, board first and get most services. Economy, that is mezzanine, waits. If the flights is overbooked, standby, that is equity, may never fly. The tranching allows different investor risk appetite to be matched with the corresponding returns. The structure also protects senior note holders, making this an efficient way to attract low cost capital. Now let's understand cash flow waterfall. This waterfall design ensures certainty of cash flow distribution. From the treasury perspectives, this gives us predictable outflow and lets us structure repo eligibility and investor tranches with precision. Think of a champagne tower at a wedding. Top glasses, senior notes fills first, overflows goes to the next layer. A securitization isn't it set and forget. It requires operational discipline, accurate data, trust reporting, and compliance management to keep the structure viable and investor friendly. Similar to managing a rental property, collecting a rent, doing reports, maintaining records. Investor expects transparency. Our AUBL RMBS 2024-1 is a textbook case for a dual purpose. It raising a long-term funding via senior tranches and retain a 75 million mezzanine or equity slice. This model allows balance sheet optimization, liquidity flexibility, which is exactly why it is such a valuable tool for the trade. Now let's see why we do this. Because it's offer a powerful benefits. Funding diversification. We are not just relying on deposits or wholesale markets. Capital relief. Subject to meeting the APRA guidelines with the significant risk transfer test, we are able to get the capital benefit. Liquidity, especially when the securities are repo eligible with the RBA. In some cases, off balance sheet treatment improves our on balance sheet optics. In Australia, we operate within a well defined regulatory framework. APRA governs the capital treatment, and RBA gets repo eligibility rules. And in case of larger bank, CFL phased out, self securitization becomes one of the critical element for meeting LCR requirement. Understanding these parameters will essential when structuring the deals. So where does this all fit into treasury strategy? For funding diversification, we can use public RMBS. For a larger bank, for LCR support, we rely on self-securitization, and for MLH ADIs, self-securitization provides contingency liquidity support from RBA through repo eligible notes. For capital efficiency, securitization provides regulatory relief. It's structured to achieve significant risk transfer. Each deal must align with balance sheet goals and regulatory settings. We have seen different structure evolves. Term RMBS, which are capital market issuances. Warehouse facilities often used by non-ADIs before terming it out. And master trust, which allows multiple issuances over time from a common pool, increasingly favors by the bank for their flexibility. Let me give you a real world example, but very high level. Consider CBA's and Westpac's RMBS program, which contains both external RMBS and self securitization. The self securitization tranches are especially designed for RBA repo eligibility. They sit on the balance sheet, fully controlled by the bank, and can be reposed in the stress event, a vital tool for LCR management. Here is a practical case in bit detail, which is of CBA's medallion is a benchmark RMBS program. For public RMBS, senior notes are issued to the investors to get the funding, and subordinate notes are held by CBA. And also, they have a self-securitization program, as a self-securitization transaction under this same program, which they use it for getting a repo eligibility of senior notes and also used under LCR. Now let's talk about self-securitization. Unlike traditional securitization, we don't sell all the notes to external investors. Let's begin by breaking down the concept of self-securitization. Unlike traditional securitization, where securities are issued and sold to the external investors, here the bank retain all the issued notes. This structure doesn't raise funding directly, but serves as a strategic purpose, a liquidity backup. In Australia, APRA mandates all ADIs having an asset base more than a billion are required to have this self-securitization program in place and issue securities so that it can be reported in the event of liquidity stress, especially create a reserve we can draw when needed without selling of assets. At AUBL, we typically use our prime mortgage book as a collateral base. We transfer these loans to a bankruptcy remote SPV, which issues RMBS notes, senior and equity. But rather than placing these notes into market, we keep them all. After meeting the RBA's eligibility and reporting standards, these retained securities can be reported, giving us an access to a central bank liquidity in case of contingency. To simplify, think of a self-securitization like a bottled water plant owner who doesn't sell their stock immediately. Instead, they warehouse it for emergency use. If deliveries are disturbed or demand spikes, they have got a secured backup supply. Similarly, our retained RMBS can be accessed for liquidity when the external market are dislocated and for contingency purpose. Here is the full flow. Our bank AUBL originate mortgages and transfer them into SPV. The SPV issues securities across the capital structure. Instead of placing them with the investor, we retain the securities. These are reported, structured, and maintained in a way that ensure RBA repo eligibility. So we can mobilize liquidity instantly in case of contingency. Let's take a moment to clearly distinguish between two major types of securitization we use in banking: market or public RMBS and self securitization. Market or public RMBS is more a traditional structure spread across the world. In this case, we sell asset backed securities to third party investors. These are rated by rating agency, in some cases publicly issued and often listed, or it is privately placed. This structure allows us to raise term funding from the market, and it usually attracts institutional investors looking for high quality, because most of the senior notes are AAA, and long duration fixed income instruments in case of RMBS. The funds we raise through this route come into the bank and can be used for future lending or balance sheet optimization. Now let's compare that with self securitization, which, as much as I am aware, available only in Australia, which operates very differently. Here we create a securitization, typically with the same structure, same type of credit enhancement mechanics, and rated by rating agency. but we retain all the notes ourselves. So we are not actually raising funds from external investor. Instead, these retained notes becomes an internal liquidity tool. Most importantly, we structure them to meet the eligibility criteria set by Reserve Bank of Australia, so we can repo them during the period of liquidity stress. In case of LCR ADIs under the APRA framework, especially after withdrawal of committed liquidity facility, these notes are very important part for their liquidity management. So to simplify, market or public RMBS is external funding, self-securitization is internal liquidity. We might think in this way: market RMBS is like a mortgaging your house to get a loan from the bank, while self-securitization is keeping your house fully paid off but getting a line of credit ready just in case. It's about being prepared without giving up control or ownership. Both tools are valuable, but the strategy behind using each one is very different. The choice depends on our balance sheet needs. Are we looking for the funds to grow or create liquidity buffer? Here is the full flow of our bank. AUBL originate mortgage and transfer them into SPV. SPV issue securitize across the capital structure. Instead of placing them to investor, we retain the securities. These are reported, structured, and maintained in a way that ensures RBA repo eligibility. So we can mobilize liquidity instantly in case of emergencies or liquidity stress. Similar to public or market RMBS, self-securitization isn't it just a one-off exercise? It's operationally intensive. We must ensure clean data, accurate loan types, legal robustness, and ongoing compliance with the RBA requirement. Our Treasury, risk, and finance team work together to keep the structure updated and repo ready. We also test system readiness periodically to ensure that in case of contingency, we are able to increase the quantum with the short notice. To wrap up, self-securitization gives us a powerful internal liquidity shield. It's about being prepared. In case of LCR ADI, it is not just for meeting LCR numbers on paper, but truly having a capacity to respond if the market freezes. For MLH ADIs, it is a contingency requirement. For a treasury function, this is an essential and flexible tool to manage balance sheet reliances in case of doing public RMBS to manage capital. Securitization is powerful, but not without a challenge. It's a complex, requiring robust legal and operational and compliance infrastructure. Market perception matters. Transparency is crucial. Regulatory exceptions keep evolving. We need to ensure ongoing reporting, trust management, and investor communications are seamless, mostly in case of public RMBS. Looking ahead, a few key trends are emerging. ESG linked RMBS aligning with the sustainability objectives, digitalization, more automation, standardization of issuing is through standard templates of some of the stock exchange do offer. Data analysis are reshaping using a latest technology and AI, and also how deals are monitored and priced are also evolving. We should be forward looking in how we structure our future deals, keeping in mind all these changes which is happening in the market. Thank you for your attention. Hope you got some understanding of securitization and self securitization compared to what you are knowing before this presentation. I welcome any questions about securitization, self securitization, and its strategic applications. If you have any query, any questions, please do not hesitate to send it across through Teams.